Let's now discuss a set of adjustments in final accounts related to the debtors and creditors. We have to understand the way of preparation and handling the bad debt, and second one is provision for bad. So while preparing the final accounts, a set of adjustments that you have to understand here is debtors related and creditors related. In case of debtors related, we have bad debt and second is provision for bad debt. Sometimes it may be named as provision for doubtful debts. You should not have any confusions over there. Provision for doubtful debts means the debt may be in doubt. There may be chances of default. That's why it is called doubtful debts. Provision for doubtful debts or bad debt. Either you can use the term provision, or in some texts they use the term reserve also for that. Rather than provision, they may use the term reserve for bad debt. Okay. And the third adjustment is all about discount on debtors. And fourth one will be provision for discount on debtors. Both are almost same, like the treatment seems to be same, like bad debt, I don't get the money. Discount, again I don't get the money. But slight difference is there. In case of bad debt, I don't get the money because my debtor is insolvent. In case of discount on debtors, I don't get the money because I have long-standing relationship and doing lots of business with him. In order to honor the relationship as well as the business, I offer him some discount, which is called discount on debtors. Ultimately, the treatments will be the same. When it comes to the creditors, we usually don't have any adjustment entries to be passed for the bad debt equivalent as well as provision for bad debt equivalent. But of course, we can call that being the discount on creditors. That will come here. So, number one, discount on creditors. We have discount on creditors here. Discount on creditors. Second, we have provision for discount on creditors. Okay. So these are the set of 6 adjustments you have to be mastered. So especially in final accounts, this will be the so important adjustments, right? So we'll see one after one then. We have bad debt and provision for bad debt here to be adjusted, right? When the amount supposed to be recoverable from bad debtors becomes default, then how do I handle? Then it's called bad debt and it should be a loss and debited to the people. Okay. C. Rupees 10,000 is the debtors amount, from whom I have to get 10,000 rupees, but out of which 200 rupees not recovered, becomes bad. This is the first scenario. It means facing the bad debt loss without having any provision for that. Okay, that's a one type. In the second type, 10,000 rupees and we have bad debt rupees 200 in this year. 200 rupees. But we have already created a provision for that. I use the shortcut or short name here, PDD, provision for doubtful debts, which is rupees 150. What does it mean? Is that okay? See, in general, what do? You actually celebrate Diwali once in every year, right? Diwali celebration. And for the Diwali celebration, you may spend around say 25,000 or 30,000 rupees as an additional to the regular income expenses you do. What do you do? From your parents' paycheck, right? Assume that salary from the salary amount is transferred for the Diwali expenses, 25,000 rupees, isn't it? So every year there is a huge expenses going to be spent during the Diwali time, as well as during the admission time of the students, right? Kids. Similarly, here also 25,000 rupees is going to be spent for the Diwali, that is transferred from the salary. If the salary being say around 40,000 rupees, usually during the month they usually spend around 25 to 30,000 rupees by default. Suddenly in Diwali time they don't have the surplus fund to manage this, right? Anyhow they have to manage, they have to celebrate. This is one way. Rather than this way, what they do? Salary and Diwali. Okay, Diwali is there. We predict that 25,000 rupees is in need for the Diwali celebration. So, releasing the 25,000 rupees from the salary exactly in that month is very expensive. What we can do? We can keep around some money away, named as Diwali fund. Diwali fund. How much? Rather than depositing full amount, every month you may transfer 2,000 rupees. So in a year's time, the amount could have been accumulated in Diwali fund is how much? 24,000. What is the spending for the Diwali by the time? 25,000. So it's now safe without any financial trouble. You can spend this money. 24,000 rupees is now used from Diwali fund account, and shortage 1,000 rupees can be taken from salary. Okay, 24,000 from here and 1,000 is from here. Is that okay? Just think over, suppose if the spending rather than 25,000 rupees, if it is just 20,000 rupees surprisingly, we spend lesser. Practically it's not possible, but I assume so, we spend lesser. If we spend lesser, we'll use that 20,000 rupees from Diwali fund, and from salary account we don't use anything. That excess surplus amount available in Diwali fund will be transferable to your normal salary expenses. Like for salary account, you can spend that, right? 4,000 is transferred, excess. You now equate the salary account is equivalent to profit and loss account. Diwali spending is equated with the bad debt. Bad debt. Very simple, right? This is bad debt. This is nothing but P&L account. What about this one? Provision for doubtful debts. Very simple. Now you understood. Now, what is the journal entry for bad debt here? Bad debt is a loss. Similar to the depreciation. Depreciation is a loss. That depreciation will reduce the value of the asset. Similarly, this bad debt will reduce the balance of debtors amount. Right. So, the value being bad debt account debit. Bad debt account debit. To bad debt account debit to debtors. How much is that? 200. Now this bad debt will be adjusted somehow. No. Where do you adjust that? By transferring to the P&L account. Diwali expenses is transferred to salary account. Similarly here the bad debt account is transferred to P&L account. The entry being profit and loss account debit to bad debt. So this is a set of entry you have to keep in your mind. Okay, this is the set of entry you have to keep in your mind. Is that clear? This set of entry will be passed when we don't have the provision for doubtful debts. So if we have the provision for doubtful debts, the pattern is different. The pattern is different. For the second one, bad debt with the provision for doubtful debts, how do I now handle this? How do I handle this? Very simple. Bad debt is a loss. What's the journal entry for that? Bad debt account debit. Bad debt account debit to debtors. How much is the loss? 200 rupees. You spend the money for Diwali, right? You spend that money. Diwali expenses to cash. Over. Similarly here, bad debt account debit to debtors. Now what do you do with the bad debt? That bad debt should usually be adjusted in the P&L account. But anyhow, we have already kept aside some money in the name of PDD, so we can use this amount to be adjusted in the PDD account. So right now the entry being PDD account debit to bad debt, to bad debt. How much is the bad debt we have for this illustration? 200 rupees. How much PDD we have? 150 rupees. So shortage is there, or shortage is there. If there is any shortage, what do you do? That shortage can be adjusted in the P&L account. Okay, if there is a surplus, then it will be transferable from the PDD to salary. Surplus will be coming in, shortage will be transferred from the P&L account. Here is a shortage, so I am going to debit the P&L account. This is for what? Shortage. This is for shortage. Okay. If we have surplus, what happens then? PDD to P&L account. This will be for surplus if we have. Surplus if we have. But in this illustration, we don't have the surplus. Now, my question is, how this 150 came? How this 150 came? This 150 is nothing but the amount created in the previous year for adjusting this one. This Diwali fund, 24,000 rupees is created by depositing each and every month some amount from the salary to this account, right? Similarly, the last year, the PDD's requirement or the expected debt loss, bad debt loss, to that extent, amount is transferred from the P&L account to PDD account. In the previous year, this might have been passed. This might have been passed. Profit and loss account debit to PDD. Okay, PDD 150. Unless you deposit, how will you get? So the opening PDD, this is called opening PDD or balance of PDD available in this year for adjusting the bad debt in this year. In this year, bad debt is 200 rupees. To adjust that bad debt, we have the PDD. Where do we have the PDD? This will not automatically comes, right? It might have been created in the previous year. In the previous year, the entry could have been PDD created, right? So from transferring from P&L account, so P&L account debit to PDD account could have been passed in the previous year. Because of this amount already available, you are using here. See, last year you created is useful in this year. Next year also bad debt will come now. What you can then do? You can create one more PDD for meeting the next year's requirement. Can we do so? Let's see here. I am going to incorporate one new thing. PDD for next year required. Okay, for next year. This is the PDD created in the previous year to adjust the bad debt in this year. Similarly, it happens in the next year also. We may face the bad debt. How do I manage that? Create a PDD in this year to meet the bad debt expense. The next year, how much we can create? It's only an estimate. It's not guaranteed number. We estimate almost 200 rupees possible. So we have to create this as a fresh one. PDD supposed to be created in this year end is meant for the next year. So the journal entry here being profit and loss account debit to PDD. This is for what? Next year's requirement. This PDD debit is what? Yes, earlier years amount created is used this year. This is at the time of usage. This is for creation. How much is that? 200. Usually while preparing, we usually club these two journal entries. These two journal entries can be clubbed to pass single entry. Like, okay, if I club these two entry, how about this? PDD debit, PDD credit. So debit side 150, credit side 200. Now it is now PDD only the credit side at rupees 50. We are clubbing these two entry. Profit and loss shortage 50. And here also profit and loss for the next year's created 200. So overall value being 250. So profit and loss account debited with 250. Is that okay? 250. And bad debt in the credit side to bad debt. This value being 200. This is what about the combined entry. You have to be careful if we don't have the provision for doubtful debts, the entry being bad debt account debit to debtors to The next one will be P&L account debit to bad debt. This is the usual one. In the second case, routed through one more provision account. Provision account might have been created in the earlier year to be used in this year. And as we expect the next year also we face some bad debt, we have to create it this year also by transferring from the P&L account to PDD account. So two entries are going to be passed. Okay, while using the previous year PDD for the adjusting the current year's bad debt, it will not be matching. If it is not matching, think whether it's a surplus or shortage. If it is shortage, the shortage is debited to the P&L account. If it is a surplus, credit to the P&L account. Usually what we do know, the usage and the next year's requirement, both the entry will be passed together as a combined entry. You have to understand this logic. So, for the second category, bad debt with the PDD, you have to pass these two entries. The second entry is the combination of these two entries, right? Come on, make a note of it. Is in the trial balance apart from the other account. In adjustment, we have been given bad debt here. Bad debt rupees 200. How do I now adjust this? How do I now adjust this? Yeah, come on, tell me. What about this bad debt in trial balance and bad debt in the adjustment? What does it mean? Bad debt in trial balance represents the adjustment entries already passed. Adjustment entry passed. We usually pass two entries, right? One is adjustment entry. Adjustment entry. Okay. Second one is transfer entry. Transfer entry. Adjustment entry is nothing but that bad debt will be adjusted in the debtors. Isn't it? Depreciation is a loss that will be adjusted in the assets account. Depreciation to asset. Bad debt is also a loss that will be adjusted in the debtors. The entry being bad debt to debtors. That is called adjustment entry. Okay. Transfer entry is nothing but ultimately these nominal accounts should be transferable to a P&L account. Okay. Now, the adjustment entry once passed means after passing this adjustment entry, if you prepare the trial balance, thereafter you have to pass only transfer entry. So we are not in need of adjustment entry, AE and TE. We are not in need of adjustment entry for this because the adjustment entry is already over. That's why the bad debt is appearing in the trial balance. Right. And the bad debt appears in the adjustment means, of course, you have to pass the adjustment entry. First of all, you have to subtract this from the debtors. Not only then, we have to transfer that, right? So, transfer entry should be passed for what? All the nominal items appearing in the trial balance, we have to pass a transfer entry. As well as the item appearing in the adjustment, first you have to pass the adjustment entry. After passing the adjustment entry, it comes inside the trial balance, then you have to pass the transfer entry. So, for this, you have to pass the transfer entry. Right. The adjustment entry for the second one, this one, we don't have the adjustment entry for bad debt given in the trial balance, only for the bad debt in the adjustment. So, entry being bad debt account debit, bad debt account debit, okay, bad debt account debit to debtors, This value being 200, this value being 200. Now we have to pass a transfer entry. Transfer entry is for what? The bad debt appearing in the trial balance as well as the bad debt appearing in the adjustments, both put together. Now the entry being profit and loss account debit to bad debt. Okay. How much we have in bad debt account? Already we have 300 rupees in the debit side. Because of passing the first entry, adjustment entry for the adjustments, 200 rupees comes in the bad debts debit account. So already 300, another 200, so 500 in total should be transferable to the P&L account. It is the combined entry for the transferring bad debt given in the trial balance to P&L account as well as bad debt. Just now we found out after the preparation of the trial balance given in the adjustments. Both. Right. See, forget about the transfer entry. If I prepare the trial balance immediately after the adjustment entry, how about the new trial balance? Debtors originally 10,000. Because of this adjustment entry, debtors is credited by 200, then the debtors is 9,800. And originally bad debt already exists in the trial balance rupees 300. Because of this adjustment entry, another 200 rupees also debited. So bad debt now being 500 rupees. This is how the trial balance will appear. So because of this way of appearance, the bad debt given in the trial balance, the adjustment is disappeared, right? Now what you have to do? You have to do only transfer entry for the bad debt available in the trial balance. Whatever the things available in the trial balance, we need to pass only the transfer entry. We don't pass the adjustment entry. After passing the adjustment entry only, the adjustment entry comes inside the trial balance. So hereafter you don't do any adjustments, only transfer entry. So we have to do only transfer entry. If I pass the transfer entry, the journal entry here being P&L account debit to bad debt 500. Bad debt 500. Is that okay? Hope so you could understand. In this case, we have prepared the trial balance after all the adjustment entry. Here, this trial balance is all about subject to some other adjustments entry also be passed. So we have to pass the adjustment entry and then we have to go for the transfer entry. Keep this idea in your mind clearly so that you can pass the entries also without any hiccup. Where bad debt without the provision for doubtful debts. Come on, make a note of it. We have bad debt. In this illustration, I'm going to discuss the bad debt along with the PDD also, provision for doubtful debts. We have debtors rupees 10,000 rupees. Bad debt also we have already in the trial balance 300. We have been given the PDD in the credit side of the trial balance rupees 200. In the adjustment, we have been given bad debt rupees 200. Second one is need to create the PDD or maintain at the rate of 5%. So I have introduced the provision for doubtful debts here. The previous class we have seen only the bad debt without PDD. Let me brief all the aspects here. The bad debt given in the trial balance is nothing but the adjustment for the bad debt is already over. So we no need to pass the adjustment entry. But of course it should be transferable to the P&L account, right? So we are in need of transfer entry at least. And PDD given the trial balance in the credit side. Always remember the PDD should be in the credit side, credit balance. If the PDD given the trial balance along with the bad debt and debtors and all, it means this will be the opening balance. This PDD might have been created in the previous year by charging the P&L account. Okay, forget about the last year thing here. But anyhow, you understand that this was created by debiting the P&L account and crediting the PDD account in the previous year happened. That's how it might have been prepared. You don't bother about that. But you have to think over the idea how this 200 could have been arisen. The 200 could have been arisen because of the transfer from the P&L account to PDD in the previous year happened. Right. The bad debt given in the adjustment is all about unknown bad debt at the time of preparing the trial balance. While preparing the trial balance, I am not aware about that this becomes the bad debt. After the preparation of the trial balance, I came to know one of the debtors is abscond or his financial position is weaker. So he became insolvent. So definitely I will not get that money. So I knew this only after the preparation of the trial balance. So as I am aware about this only after the preparation of the trial balance, the journal entry could have been passed, could have to be passed now only. So I am going to pass the journal entry now. Adjustment entry should be passed now. Not only adjustment entry, by passing the adjustment entry, this will come inside the trial balance. So we have to prepare the pass the transfer entry too for this. What about the PDD given in the adjustment? Usually PDD in the adjustment will be at some rate, 5%, 4% like, because it's only an estimation. It's only an estimate. So how do I estimate? So I estimate based on some percentage on that. So you also have some idea. When I earn some money, 20% can be used for spending and for recreation, and 5% can be used for charity purpose. Like this, you can think a lot. 5%, 10%, whatever it may be. That's an estimation. Here also the estimate comes as 5% is meant for the PDD. 5%. This is nothing but provision required to meet the bad debt in the next year. For next year. For next year. For that, you have to pass the transfer entry. Transfer entry means what? Amount should be created, right? So creation is nothing but transferring from the P&L account debit to P. This entry you have to pass. Clear? Now, before I go for passing the journal entry for this, let me give the working note here. Working note. How this will appear in the balance sheet as well as P&L accounts debit side. For that, you need to have the working note for the bad debt first of all. Debtors. How much is the debtors here? 10,000 rupees. Minus bad debt given in the adjustment. Okay, because we have to pass the journal entry for the bad debt, right? For this, if I pass the journal entry for this, what is the journal entry here? Entry for bad debt. Entry for bad debt. Okay. Number 1. Bad debt account debit. Bad debt account debit to debtors account, right? Value being 200 rupees. Value being 200 rupees. Remember, this bad debt given in the adjustment. This bad debt given in the adjustment. Bad debt given in the trial balance, where for that the adjustment entry could have been already passed. You don't need to worry about that. So only the bad debt given in the trial balance requires the adjustment entry. So I am passing that. Because of this entry, debtors is credited by 200. The debtors balance will decrease by 200 rupees. I am doing that on here. 9,800 rupees is supposed to be recoverable in the near future. Though I estimate the recoverable amount may be 9,800. Among these debtors also there may be some default, right? For meeting that default losses like bad debt, we have to make a provision. That provision should be some percentage. Can we assume or roughly around 5% or 3%? Like that estimate is given in the adjustment, so which is 5%. Less provision for doubtful debts. Provision for doubtful debts given in which adjustment account. Bad debt is also given in adjustment and provision is also given in the adjustment, which is 5% on this, 490. Balance amount will go to the balance sheet. The value be 9,310. 9,310. This entire block will appear. This entire block will appear in the balance sheet asset side. The balance sheet asset side. Right. Now, in balance sheet, debtors. How much is the debtors here in balance sheet? How much? 9,800. We have to start from here only. Bad debts a loss debited to the P&L account. Usually we don't adjust that in the balance sheet. Minus PDD. PDD being 490. In the outer column, 9,310. Or sometimes the PDD could be posted in the library side also accepted. Library side also accepted. And next will be how this will appear in the P&L account, sir. Especially in the debit side, this is going to appear. How? Bad debt given in the trial balance, bad debt given in the adjustment, provision for doubtful debts we supposed to create for the next year given in the adjustment. All these amount are going to be charged to the P&L account, right? Bad debt is a loss, debit to P&L account. So this is also required to be transferred. For this will be done. And the new bad debt we came to know only after the preparation of the trial balance given in the adjustment. This will also be transferable. This is here. For the next year, again, I have to create the PDD, transfer the P&L account. So this is also transferred here. These are the three numbers. Bad debt in trial balance is how much? 300. Bad debt in adjustment, 200. Provision for doubtful debts required to be maintained for adjusting the bad debt the next year being 490. So much money we are in need. All these things will be debited in the P&L account. 990 debited. But to adjust these losses, we have already created the PD in the previous year. How much we have? 200 rupees. This 200 can be used. Means you can subtract this amount from PDD of the opening one, which is nothing but given in the trial balance. The value being 200. If I subtract, the ultimate value being only 790. So I am going to debit to the P&L account only 790. Is that okay? 300 rupees already be adjusted with the debtors available in the trial balance to be debited to the P&L account 300 rupees. 200 given in the adjustments, we have to first pass the adjustment entry and then transfer entry. That should also be transferred to the P&L account 200 rupees. Next year's requirement for adjusting the bad debt, which is PDD given in the adjustments at rate of 5%, which is 490, also transferred. 990 rupees we are in need to be debited to the P&L account. Do you have any provisions for adjusting these kinds of losses created in the previous year? Of course, we have that. This is given in the trial balance credit side. That 200 is subtracted, so balance 790 is going to be debited to the P&L account. Now, so we have passed the bad debt account. Next will be transfer entry. I am going to pass a transfer entry for existing bad debt and new bad debt. So the entry being P&L account debit, so not P&L account, PDD is there, no? So PDD account, routed through PDD account. So PDD account debit to bad debt. How much bad debt is going to be adjusted in the P&L account? We supposed to adjust 500 rupees. How much we have to adjust? 500. How do I get? 300 rupees is there. Newly created another 200 rupees is there. So 500 rupees. That entire 500 rupees could be adjusted in the PDD account. Okay. So how much PDD value we have? 200 rupees only. So we are in need of 500 rupees, but we have only 200 rupees provision created the previous year. Still we are short. We are facing the shortage of 300 rupees. That shortage can be charged to the P&L account. So P&L account. And I need to create again PDD for the next year. How much is the PDD supposed to be created for meeting the bad debt the next year? 490. That entry being, come on, P&L account debit to PDD. Is that okay? This value being 490. We can club these two entries. To pass as a single entry. If I club these two entries, PDD debit 300, credit 490, ends with the PDD credit sign to be rupees 300, so 290. Am I right? And P&L account debit side 300, another debit value 490. You have to add these two. So the P&L balance here being 790. And bad debt credit side, so to bad debt rupees 500. See the value what we debited in the P&L account is this 790. Ultimate amount to be debited in the P&L account is 790 by passing the entry like you can pass or expose that in the P&L account, or simply you can keep these two adjustments in your mind. Working note number 1, this is the working note number 2. Okay, most often you may not be asked to pass the journal entries as well as prepare the ledger for the bad debt and provision for doubtful debts. In a comprehensive final accounts, you need to directly finish up these two working note. Working note number 1 is all about debtors minus bad debt minus PDD. Working note number 2, the amount supposed to be transferable to the P&L account, bad debt existing, bad debt newly found out, and PDD required for the next year. From there, subtract the PDD already available. Okay. If the PDD available already, rather than 200, if it is 1200, what happens then? 990 minus 1200. It's almost 210 excess. Then that value will go to the credit side. That's all. Is that okay? So keep this point in your mind. That's all. Come on, make a note of it. The money from the debtors, we could have offered, right? For example, 2000 rupees we have to receive from the debtor, but they have paid only 1950. Okay, 1950 is considered as receipts, another 50 is adjusted as discount allowed. The discount allowed is nothing but discount on debtors. Adjustment entry is already passed, so you no need to worry about the adjustment entry for this 300. But of course, we have to transfer that to the P&L account. For that, we have to pass the transfer entry. Discount on debtors given in the adjustment means we have not provided with the, we have not passed the adjustment entry. Usually, discount on debtors will not be given in the adjustments. You might have not seen the discount on debtors being the adjustments in most of the sheets. Usually you won't see. But of course, if you are able to think in a different way, this discount on debtors will also come in the adjustments. For example, one of my debtors who has to pay me 10,200 rupees, he paid 10,000 rupees, I just wrote that as 10,000 amount recovered. Sometimes later I sent a reminder letter to him. Sir, your account shows a balance of 200. Immediately he says, sir, since very long ago, I am doing the business with you for so much of volume also. Don't you give me even 200 rupees discount? If he expects a discount of the unpaid balance, because of the long-standing relationship, what I do? Okay, sir, I'll offer the discount. So if I offer the discount with later after a period of collection, usually discount will be adjusted on collection. But in this case, the 200 rupees remaining amount recoverable from the debtors is going to be offered as a discount after sometimes later with the negotiation with the partner, with the party. Okay, I'll offer the discount, sir. Then what's our generally for that? Discount on debtors account debit to debtors. While collection, bank account debit to debtors. While collection, we collected after a small discount, then the entry being cash account debit, discount account debit to debtors. But now what happened? Sometimes later on verification, only a penny amount is pending from him. On sending the reminder, he says, sir, offer me discount. Okay, I'll just give the discount. Without any further collection, I offer the discount. Then the entry will be only discount entry, discount to debtors. On preparing the trial balance on 31st March, I am not aware about that. So after the preparation, I just inquired, what about the pending, sir? Immediately say, sir, offer me the discount. Okay, just now I came to know the offer is going to be given to the debtors. No need to pay the balance amount. Okay, not at all pass the entry. Now, in such a case, the discount and debtors will come in the adjustments also. So the treatment is similar. In the case of bad debt, the journal entry will be same, right? So bad debt to debtors. The same entry will be applicable here. Rather than bad debt, I am going to charge the amount to the discount on debtors. That's all. So for this, we have to pass the adjustment entry as well as we have to pass the transfer entry, both. Okay, come on, pass the adjustment entry first of all. Adjustment entry is applicable only for the item given in the adjustments. The entry being discount on debtors account debit to debtors. It's a similar to the bad debt account. Bad debt without provision for doubtful debts. You can link that study with this so that it will be pretty easy. Discount on debtors to debtors account value being 200. And transfer entry. Transfer entry will be, this is for the item given in the adjustment, because while it is given in the adjustment means you have not passed the adjustment entry. So now I have to pass the adjustment entry. Once adjustment entry is passed, this amount is already adjusted to the trial balance. Into trial balance we have already 300 and another 200. So 500 rupees is the total discount on debtors is allowed now, transferable to the P&L account, the entry being P&L account debit to discount on debtors. discount on debtors. The value being 500. The value being 500. Is that okay? Come on, make a note of it. For discount on debtors with the provision for discount on debtors also. Let me decode the terms here. Discount on debtors given in the trial balance, for that adjustment entry is already over. Adjustment entry is already over. Then we have to pass only transfer entry. And provision for discount on debtors given in the trial balance represents the provision for discount, offering discount is already created in the previous year, assumed to be the opening balance. This might have been created by charging the P&L account in the previous year. In the previous year, the journal entry could have been this one. P&L account debit to provision for discount on debtors. This might have been created in the previous year. Least bother about this one now. But why do I pass? To have the link, what happened, what could have happened in the previous year. That will give the complete view about the chart. And in adjustment, discount on debtors is given. What does it mean? We came to know this discount only after the preparation of the trial balance. As we are not aware about this at the time of preparation of the trial balance, we might have missed the adjustment entry. So we have to adjust that. That's why we have to pass the adjustment entry. Not only the adjustment entry, after passing, we have to transfer this discount on debtors being the nominal account to the P&L account. So transfer entry should also be passed. And for the second, provision for discount on debtors at the rate of 5% is supposed to be created. What does it mean? This is the provision meant for the next year. So to meet the discount on debtors expenses in the next year, we are creating a provisions today. Okay, for the next year. How do I create? By charging P&L account, I will create this provision. Provision for discount is created. Is that okay? Now let me pass the entry one after one. So first, what you have to do? You have to pass the entry for what? This adjustment entry number 1. Okay, adjustment entry for discount on debtors. For which discount on debtors? Given in the adjustment. Discount on debtors given in the trial balance. For that, the journal entry was already passed. You don't need to worry about that. So I am going to pass the entry for this. The entry being discount on debtors account debit. Discount on debtors account debit. Okay. Discount on debtors account debit. On debtors. DRS. Debtors account debit to debtors account. The value being 200. Value being 200. Second entry is all about transfer entry. Transfer entry is for what? Existing debtors, discount on debtors in the trial balance, as well as the new discount on debtors we found out only after the preparation of the trial balance. These two will be clubbed and transferred. So the entry being, okay. As we have the provisions, first of all, we have to adjust that in the provision for discount on debtors. So you have to club all the three. Provision for discount on debtors, account debit, to discount on debtors, The discount on debtors in total being 300 plus 200, 500 rupees. But how much is the provision we have already? 1000. We have already 1000, but we are in need of only 500. Then the difference should be transferable to the P&L account. Surplus we have. Surplus. Shortage is there means P&L account is debited. Here we have surplus, they are credited to the P&L account. And the third entry is all about the provision supposed to be created for the next year's requirement. Okay. Creation. Okay. Provision for discount on debtors for the next year. The entry being P&L account debit to provision for discount on debtors. 5%. 5%. 5% on what? Debtors. What is the balance of debtors? Actually, we have 10,000 rupees as the balance in debtors in the beginning, or as per the trial balance. By passing the adjustment entry, debtors is subtracted by 200 rupees for the unadjusted discount on debtors. Thereafter, we have only 9,800. For the 9,800, 5% will be created. So 490. 490. So if you are creating any provision up to that point, what is the debtors balance? You have to find out that first of all, and from that only 5% will be created. Or you can have this as a small working note. The small working note is this way. Debtors balance being 10,000 rupees. From there minus discount on debtors. Discount on debtors given in the adjustment, which is 200 rupees. Balance being 9,800. From the 9,800, we have to subtract what? Provision for doubtful debts given in the adjustment meant for the next year, which is certain percentage on this value, which is 5%. 490. So balance being 9,310. This way also you can work out. This block will go to the balance sheet asset side. This will go to the balance sheet asset side. Right. If I open the balance sheet in the asset side, this will appear. Debtors 9,800 minus provision for discount on debtors 490. In the outer column, the ultimate value being 9,310. And how about the P&L account, sir? It's very simple. Similar to the debtors. Discount on debtors transferable to the P&L account. Here is transferable to the P&L account given in the trial balance. The value being 300. Discount on debtors given in adjustment transferable to the trading account, which is trial balance. So transferable to the P&L account, which is 200 rupees. And we supposed to create a provisions for the next year's requirement by charging the P&L account. So provision for discount on debtors given in the adjustment. The amount given in the adjustment is meant for the next year, which is 490. 490. This is calculated either this way, this statement, or you can find out this way also. This way, both the way you will get. So the overall value being 990. From there, if we have any opening provision minus provision for discount given in the trial balance, 1,000. Now the value is negative, so you put that value in the credit side. The entire block you can write in the credit side. Discount and provision for discount, both put together, the value should be 10 in the credit side, not in the debit side. You can simply, rather than passing these two entries, what is the first entry here? The first entry here is provision for discount on debtors and discount on debtors to P&L account. No, it's only adjustment entry. Adjustment means transfer entry. You are transferring, and this is nothing but creation entry. You can club these two and pass this as a single entry. Provision for discount on debtors, debit side 1,000, credit side 490. Ends with 510 only in the debit side. So provision for discount on debtors, the value being 510. Right. Then in P&L account, debit side 490, credit side 500. Ends with 10 rupees in the credit side. So 2 P&L account, 10 rupees here. And discount on debtors, in the credit side we have 500 rupees. Discount on debtors, value being 500. Now verify. This will be the ultimate value. The amount supposed to be credited in the P&L account being 10. Is that clear? So the complete idea will be only these things for three components. Bad debt component, discount and debtors component. Discount and creditors component are also the same, but in a reverse way. Yeah, make a note of it.